No matter which trading strategy you follow, aligning with the trend generally increases your odds of success, but you need to stay alert for potential reversals as they can wipe out your gains also. Significant pullbacks might trigger your stop loss even if your directional bias was accurate. There's a popular phrase, the trend is your ally until it's not. So is there a straightforward and rule-based method to determine true market direction and detect reversal cues the market sends? The answer is yes, and in this video I'm going to walk you through the exact steps to do just that. So if that's something you're into, make sure to hit the like button to support more content like this and subscribe if you're new here. See you after intro and disclaimer. The market consistently shifts through phases of impulsive and corrective movements driven by trader behavior. Impulsive legs are defined by candles of the same color with large bodies and significant distance. Covered corrective phases or pullbacks in contrast show candles of varied colors with sideways wicks and shorter movement distances. In a textbook trending environment, price makes higher highs and higher lows while respecting each swing low. Every time the price closes above a key level, it confirms the trend continuation and creates a demand zone by default. On the flip side, when price breaks below a key level, it could indicate a potential trend change. Now here's where many traders get stuck. Is the current move just a pullback, or is the entire leg one single move to be considered? Put simply, is this a swing low or just meaningless internal price noise that can be ignored? Because if it's a valid swing low, a break beneath it may suggest reversal, but often price just resumes climbing post breakout. So let me walk you through the most systematic technique to confirm real pullbacks and ignore the internal fluctuations and noise. This method applies Fibonacci retracement levels to identify the depth of a correction. Here's the process when the market forms an impulsive move. We apply the Fibonacci tool from the beginning of the impulse to its end. For a correction to be seen as legitimate, it needs to reach at least the 38.2% retracement level. If the price fails to touch this level and keeps pushing upward, it's typically just internal fluctuation, a weak reaction lacking true correction. Its shallow retracements are unreliable and may produce misleading signals. By waiting for the pullback to reach the 38.2% level or beyond, we make sure we're only responding to significant corrections, not background noise. In this scenario, the entire move is treated as one leg and a reversal is only valid if the market drops below that specific swing low. Let's summarize this using a bearish example. To confirm a valid pullback, the retracement needs to touch at least the 38.2% Fibonacci level of the previous downward leg. If the correction falls short of this level, we treat it as minor fluctuation rather than a true pullback. Its shallow retracements often lack genuine selling pressure and may deceive traders into anticipating a reversal too soon. For instance, let's determine if this specific move qualifies as a real pullback or just noise in the price action by applying the Fibonacci retracement from the beginning of the impulse to its end. We'll observe that it reaches the 38.2% level. This verifies that the move is a valid pullback, indicating the market paused enough for profit taking or counter trend interest. Providing structure to the chart from here, if the price resumes in the trend's original direction, we see a structural break and can confidently seek continuation trades. On the flip side, if the retracement only hit something like the 23.6% level or less, we'd classify it as internal noise and view it as one continuous bearish leg, meaning no structure break and no confirmed swing high. Now that we've clarified impulses and pullbacks, let's move on to identifying the overall market direction. When we observe 1, 2, 3 movements breaking past the prior structure, it indicates the presence of a trend. If the price then develops another correction followed by an impulse, it confirms trend continuation. Now this is where a crucial concept comes in. We identify the lowest point of the correction as our swing low, but only after a structure break has taken place. This implies that during a pullback the market might create several lows, but these aren't confirmed swing lows. A drop below these minor levels doesn't necessarily signal a trend reversal. The actual swing low is validated only once the structure is broken. At that point, the lowest part of the correction is recognized as the swing low and a break beneath it suggests a potential reversal. Now let's examine a bearish price action setup to apply this concept and remove any confusion. So here we're observing a bearish market setup. At first glance, it might look messy with no obvious direction, but we'll apply our method to uncover what the market is actually signaling as the price action unfolds. Keep this in mind too when trading a trend continuation pattern. It's better to stick with charts where the direction is well defined and avoid sideways or uncertain markets. Now let's go back to the beginning. We see 1, 2, 3 moves breaking below the previous structure, indicating a downtrend. This gives us our low high and a lower low. If price drops below the latest structure again, it confirms the trend continuation and the next correction should develop within that range. Let's see what follows. The market makes a minor pullback and continues lower after this new structure break. We can identify the latest swing high and low falling below. The swing low confirms continuation, and moving above the swing high suggests a potential reversal. Once again, the correction takes place inside this boundary. But the question is this a legitimate pullback or just minor fluctuation in price? To find out, we use the Fibonacci retracement tool to measure how deep the pullback goes. Applying the tool from the start to the end of the impulse shows the pullback doesn't reach the 38.2% level, meaning this isn't a valid correction. We treat the entire move as a single leg moving forward. We get yet another structure break to the downside and mark a fresh swing high and low. The downtrend remains intact as long as the price holds below the new swing high. Next, the price touches this structure level but fails to break it. Long wicks here indicate sellers pushed price past the swing low, but it quickly rebounded. This suggests some buying interest is emerging, but technically we stay in a downtrend. While below the swing high, price tests this level again and finally breaks above the swing high. This signals a potential shift to the upside and could start a new uptrend. However, to confirm the uptrend, we need to see 1, 2, 3 bullish moves. Now let's check what unfolds next. The price sharply drops and breaks below structure again. Now the market is creating confusion, breaking both bullish and bearish levels. When this happens, it signals indecision. We must wait for clarity and observe whether buyers or sellers take control. Then we return to tracking clear impulses and corrections. Here's another major point: only trade when you understand the market environment. You're not required to take trades daily. Being patient for strong setups is a key habit for consistency. Now moving forward, price forms 1, 2, 3 bullish legs, breaking above market structure, confirming an uptrend. Then we get another impulse followed by a pullback. So yes, this counts as trend continuation. Staying above the swing low keeps us within the uptrend, and a break above the prior high signals ongoing momentum. If we were to visually mark trend direction in this case, it would look like this. Red zones indicate bearish trend, green shows bullish trend, and gray represents indecision with no clear direction. Now that we've examined the breakout behavior, let's dive into what makes a breakout truly valid. We've already emphasized multiple times that a break of structure indicates a continuation of the current trend. It also helps us clearly define recent swing highs and lows. But now let's break down what truly makes a break of structure valid. A break is only confirmed when a full-bodied candle clearly pierces and closes beyond the structure level. A wick pushing beyond the level might show temporary momentum from buyers, but it also highlights an immediate rejection, suggesting that the move lacked strength. This often looks like a liquidity grab, where stop losses are triggered above previous highs, luring traders into false breakouts. If price makes another attempt and this time closes beyond the level with a strong candle, we can consider it a confirmed breakout. At that point, the base of the move that led to the breakout becomes our identified swing low as long as the price holds above this point, we remain in bullish territory and focus on long positions. Now let's consider the opposite scenario. If price breaks and closes below this significant demand zone, it indicates buyers failed to maintain control, and that sellers are now driving the market. This break suggests the uptrend is over and that a potential bearish reversal could be forming. When price decisively breaks through such a key level, it signals a clear shift in market structure and the momentum turns in favor of the bears. This moment is called a change of character, or CHOCH. It marks a transition in sentiment from bullish to bearish and gives us a signal to adjust our trading bias accordingly. A change of character, CHOCH, is one of the most powerful signals in price action trading, but it's not always valid. In fact, there are two common scenarios where what looks like a CHOCH might be misleading. These exceptions often confuse traders and lead to premature trade entries. So let's break this down step by step and understand when a CHOCH is not reliable, and how to avoid falling for a false shift in market direction. Right here, we see a major swing low that initiated the breakout. At first glance, a break below this level might appear to be a valid change of character. But if you observe the left-hand side, there's something crucial. This level aligns with a key liquidity zone. Here's what's happening. Many traders previously entered long positions from this area and placed their stop-loss orders just beneath it. As a result, a large pool of liquidity has built up below that level, waiting to be triggered. Smart money is aware of this. To trigger those stop losses, they often drive the price downward temporarily, sweeping the liquidity, before reversing and continuing the move upward in line with the prevailing bullish trend. Here's the bottom line. When a major swing low coincides with a liquidity-rich zone, a break beneath it often represents a liquidity grab, not a true market reversal. In such a scenario, we don't treat this as a valid change of character. If price reclaims the range after the sweep, it presents a high probability long opportunity. Why? Because the bullish trend remains intact, sell-side liquidity has been activated, and the market is now likely to pursue buy-side liquidity targets. As smart money traders, our edge lies in entering after liquidity has been taken, when the genuine move begins. Let's discuss another concept that can also make a change of character invalid: the mitigation of fair value gaps. As a smart money trader, identifying FVGs should be one of the first steps you take when analyzing a chart, because these zones often act as magnets for price. In most cases, before continuing its trend, the market pulls back to fill these gaps. This is why FVGs are critical zones to watch. They're most effective on intraday timeframes such as the 4-hour, 1-hour, or even smaller timeframes. Now here's where it gets interesting. Let's go back to the earlier example. Look closely at the left-hand side and you'll spot an unmitigated fair value gap sitting just below the major swing low. In scenarios like this, price often retraces to the FVG zone to fill the gap. This pullback doesn't indicate a true reversal. It's simply the market rebalancing itself. The bottom line: always check the left-hand side of the chart for unfilled FVGs. This helps you distinguish between a move that's just filling a gap and one that reflects a real shift in market sentiment. By doing this, you can avoid false signals and stay aligned with the bigger picture. Now that we understand how to identify market direction using breakouts and changes, let's take it a step further and see how the system of market sentiment actually works. The system operates based on mitigations. When price mitigates a demand level, demand takes control over supply. Conversely, when price mitigates a supply zone, supply takes control over demand. I know it sounds so strange, but it all will make sense in a minute. Imagine the market is in an uptrend, forming a series of higher highs and higher lows. Each time price breaks structure to the upside with fair value gaps, a strong demand zone is created. These demand zones remain unmitigated until price revisits them, offering ideal opportunities to trade with the dominant trend. However, if the price breaks below a strong demand area, it forms a change of character. This signals two key things. First, supply has taken control over demand, and second, a new valid supply area has been established. From there, the price continues moving downward, forming new supply zones until it reaches the next unmitigated demand area. At this point, a battle between supply and demand occurs. Sometimes this results in consolidation and a ranging market between these two zones. A break above or below the range will determine which side gains control. Now a quick tip for the end of the video: don't chase the market, let the market come to you. Having patience, trusting your analysis, and waiting for mitigations can be the difference between a winning trade and a losing one. That's it, traders. Thanks for watching this video. So guys, I hope this video brought you some solid value. If it did, go ahead and smash that like button to show your support. And if you're new here, consider subscribing to the channel so you never miss out on future insights. See you in the next episode.